Did the recent Fed rate cut mean you should expect lower mortgage rates? This is a question I'm receiving daily, so let's clear up the confusion between the federal funds rate and the mortgage rates. The Federal Reserve lowered the federal funds rate by 50 basis points, sparking widespread discussions. Many consumers believe this means mortgage rates will also drop, but that's not necessarily the case. In this video, I'll discuss why a cut in the federal funds rate doesn't directly translate to lower mortgage rates and explore the factors that influence mortgage rates. You'll be better equipped to manage the housing market and make informed decisions by understanding these nuances. First, let's discuss the federal funds rate. This is the interest rate at which banks lend each other money. Think of it as the rate banks use to balance their books at the end of each day. When the Federal Reserve lowers this rate, it primarily impacts short-term borrowing costs, such as credit card rates, personal loans, and other forms of adjustable rate debt. So while a lower Fed funds rate can make some borrowing cheaper, it doesn't directly affect long-term loans like mortgages. Mortgage rates are a different story though. They're more closely tied to long-term economic indicators like inflation, unemployment, GDP growth, and job creation. Chairman Powell mentioned these factors after the Fed announced the rate cut, but they were often overlooked in news reports and social media posts. Investors who buy mortgage-backed securities pay close attention to these economic indicators. If inflation is rising, for example, investors demand higher mortgage yields to compensate for the decreased purchasing power of future mortgage payments. This means that even if the Fed lowers the federal funds rate, mortgage rates might not move in the same direction if these other economic factors aren't aligning. So why is there a disconnect between the Fed funds rate and mortgage rates? Well, mortgage rates are influenced by the bond market, specifically the yields on long-term treasury bonds. Investors worried about the inflation or seeing strong economic growth may demand higher interest rates on these bonds, pushing mortgage rates up. In some cases, mortgage rates can even increase after a federal rate cut if investors believe the rate cut will lead to higher inflation. Understanding this disconnect helps set realistic expectations. Knowing that a lower federal funds rate doesn't guarantee lower mortgage rates is essential. If you found this information helpful, please like this video and subscribe to our channel for more insights. Contact me if you have any questions about how current interest rates affect your mortgage options. Thanks for watching, and we'll see you on the next video.